Welcome to the BankTalk podcast, the show where we talk to leaders and experts from the community banking sector. Whether you are a current CEO or aspire to be one, this podcast will give you valuable insights and advice on how to run your financial institution better. Each episode features a different topic and a guest who shares their experience and knowledge with us. Tune in and learn something new with BankTalk podcast.
Hi, and welcome to Bank Talk. I'm Charlie Kelly, your host and partner at Remedy Consulting. Today, we're talking about the collapse of Synapse. Synapse was a middleman in the banking as a service space and recently went under, and that caused quite a bit of distress for customers of the bank, the fintech. At a certain point, they were trying to figure out how to sort out the dollars. Ended up in each account. So today we have with us Chris Davis. Chris is with Riverbank. The Riverbank folks have recently gotten into the banking as a service. So I thought we would try to get a banker on and spend a little bit of time just talking through what they see in this collapse and, things to look out for if you're thinking about going in the banking as a service space. So without further ado, let's get to Chris. Hi, welcome back to Bank Talk. Today, Chris Davis. Chris, thanks for joining us.
Yeah, thanks for having me.
So, Chris, you're at Riverbank. Why don't you tell us, just give us a little bit of background. What specifically within the banking as a service space, what are you guys up to there? And, just kind of how are you thinking about things?
Yeah, absolutely. So Riverbank's in Spokane, Washington, for those that don't know about us. We're a traditional commercial community bank. And I would say over the last, call it 2.5 years, we really started dipping our toes into the banking as a service fintech space to figure out, is that an area that we want to play in, support, and, make a splash within the industry as an institution. So we spent about 2 years of developing a strategy, building a plan, really curating who we wanted to be in that space and what fintech partnerships we would want to attract and go to market with. And so I would say really over the last 6 months, we've really dug our heels in and investigated what that partnership should look like, would look like, and how we would take our first fintech partner to market. And exciting thing is we're looking to do that before the end of this year. So hopefully November, we're going to take our first partner live. But really our position in the space is more on the deposit side. And so what we're looking to do is allow our fintech partner to offer commercial business checking accounts to its customer base. And then we'll support that on the back end and allow all the transactions activity as far as movement of funds, payments, and things of that nature. So we're really just focused on the deposit piece, but this will be our first fintech partner to take live. So we're excited for that opportunity.
Oh, excellent. Yeah. And maybe I should have vetted this a little bit with our listeners because we, here at Bank Talk, we jump topics a little bit. So banking as a service is effectively allowing the fintech to use your infrastructure per se, right? Your regulatory infrastructure in order to basically bank with, under the auspices of your bank is the way I'd categorize it. I probably don't have that exactly right, but yeah, after doing this for a little while and trying to get this fintech partner lined up, would you categorize the same way or?
Yeah. Essentially, we're lending our charter more or less. Most fintechs, they're not going to be able to apply for a bank charter nor obtain that bank charter. So that's really where they look for that partnership to be able to creatively go to market with their solution. And so we, as the financial institution, offered them the ability to build off of our platform, integrate into our infrastructure to allow them to enter the marketplace to be able to offer those financial services to a customer base that we might not otherwise have done ourselves.
Okay. But otherwise, for the most part, you're on the hook as the bank.
Absolutely. Yeah.
Really, the relationship, the regulators, all that business, right?
Every bit of it. Yeah. The bank we bear the burden of risk and all regulatory compliance and oversight 100% belongs to the bank.
Okay. So you have to find enough of financial value to overcome that, I would imagine, right? As a bank.
Yeah, correct. Yeah. It has to be a partnership that makes sense, right? So when you're looking at a fintech partner, they need to align culturally with who you want to be and who you are, but also that they share the same appetite of risk and are willing to manage the risk alongside you, because that's the most important thing here is managing that risk.
Yeah, gotcha. Okay. So I want to dig into this a little bit. the title of this is going to be some discussion around Synapse, but I think really what I was trying to get through this was more about how does that account relationship work, right? So specifically, can you just give me a feel for what a middle, a program manager is in this space, what it looks like with or without a program manager if you're either the bank or the fintech? Just give us a feel for sort of how the customer experience or the flow works from, sort of fintech to program manager to bank.
Sure. Yeah, in its simplest form, a program manager, really what they're doing is they're building that infrastructure, right? So they're building the tech stack that allows that fintech to connect to be able to deliver and offer the solutions they need to out into the marketplace. And some fintechs have their own tech stack, and so they're just laying on top of the middleware. But really what that program manager is doing is connecting the fintech to the bank. And the way that it most traditionally works is the program manager is running the FBO model. So where they have a lot of subledgering and everything's rolling up to that one FBO account. And that's kind of been, I would say, the industry norm as far as program managers are concerned, and how they are able to scale and really grow at a very fast pace to allow not just one fintech, but multiple fintechs to connect into one banking partner or bank relationship, or many bank relationships. A lot of times a program manager may sub out multiple bank relationships to just one fintech, depending on their growth. Some fintechs grow rapidly, and that may far supersede or outweigh what that one bank can support. So some program managers load balance, I guess, is the easiest way to think about this, to where they're ensuring that they can support not only the bank partner, but the fintech as well. But again, in its true and simple nature, that program manager is really just there to help connect the dots or the endpoints between the fintech and the bank. And again, traditionally, that's run on the FBO model.
Okay. And so they're not, when the services they provide to the fintech is probably not going to be user experience, right? It's not going to be client facing. What does my site look like? How am I getting you there and back? Typically, that's not the program manager's role, correct?
I would say majority of the time that's correct. Yeah, the fintech really controls that user experience or the UX, and then to some degree they may share the UI, so the back end. The program manager may supply some of those needs if the fintech's not building that themselves. But a lot of the fintechs they do focus really heavily on the user experience, and then sometimes they need some support on the back end. So they're able to manage the services that they're offering. And it really just depends, I would say, the maturation of the fintech, where they are in their life cycle, and then what they need from the program manager versus what they're creating themselves.
Okay. All right. So let's dig into the Synapse thing a little bit. And so my understanding of this, or at least what I've read on it, is that at a certain point, Synapse went bankrupt. As part of that, or just went out of business. As part of that, so now the middleman the person in the middle somehow fails. And now you have a bank and a fintech trying to define what's in the accounts, what they belong to, who they belong to, right? Which customers they belong to, et cetera. How can you explain that a little bit? Like how and I'm not asking you to explain what exactly happened at Synapse, but how could, if the middle collapses in a scenario where you have a program manager, can you give us a feel for what that might look like if you were, if you as a bank sponsor chose a program manager and a fintech? What is that?
Sure.
Now all of a sudden the middle falls out, I think, right? It starts looking like a donut or something. I don't know.
Yeah. And I'll give you just my pure opinion on this, because to be completely candid and transparent, we're not using a program manager for our partnership and the way we're building fintech. We're doing it a lot differently. We're not doing the FBO model or anything like that. So just from my understanding and knowledge of what happens in this industry, the biggest stopgap or fail safe here is managing that ledger, right? So managing and being able to reconcile the FBO account to all the sub accounts and understanding what makes up this balance, right? Mm-hmm. What is actually happening at the macro level from the micro details. And so where, again, my opinion only, things went south is they weren't reconciling. Things just started becoming unchecked, unbalanced. And again, who's to blame for that? Your guess is probably as good as mine.
Sure.
But collectively, to go back to the very first question you asked, is whose responsibility is it? Well, it's always the bank's, right? So the bank has table stakes at this, regardless of what the program manager is providing, and regardless of what they say that they will, give you insight into or provide from a reporting standpoint. The bank has to always ensure they're in balance.
Okay.
And so I think where things kind of started, having some missteps is they weren't balancing or reconciling to one another is my only guess of how this kind of started to collapse on both of them. And once you get to a point where you just have no clue what's in and what's out, you can imagine the nightmare that brings you, and being able to reconcile and really truly give customers access to the funds that they're supposed to have. And that's where the frustrations, what we've seen in the, the news outlets and the media and everything like that, that's where the customers are the most frustrated is they feel held captive, right? They don't have access to those funds that they otherwise thought they should have access to. And a lot of that is because you can't reconcile, well, what belongs where and what belongs to who. And I think that's the biggest missed opportunity in the fintech space, is to get to a point where you truly can't service and meet the needs of your customers because you didn't do the right balancing, checks and ledger just, again, fell apart.
Right. Okay. So I'm going to break that down a little bit, because I'm going to give you my understanding of this and maybe expound upon what you just said.
Sure.
So the fintech relationships that I have run into in my career, and it just seems like there's getting to be more and more of them. At one point, there would seem to be a model out there where you might have one core account and then these sub accounts. I think that's what you're talking about with sort of one GL account, a bunch of subs.
Correct.
My understanding is the reason for that at one point was because if you pay your core $1 an account, and you could make that into 1,000 accounts on the other end, right? 1,000 sub accounts,
Sure.
it would be a lot cheaper to be able to run those accounts. So that was one of the reasons around sub accounts. I'm sure that as you go through and you identify, if you do not have a one-to-one relationship, core account to fintech account, we'll say, for lack of better terms, the terminology might be wrong. If you don't have a one-to-one, you need an interpreter in the middle. You need somebody that's going to interpret that. And if the fintech does not hold the keys to, if there's $1,000 in the account, in the master account or the core account, and you have 1,000 fintech accounts of $1 each, and you don't know whether they're $1 each or 85, one's got 85, one's got $1.15, could get pretty messy if there isn't somebody kind of making sure that ledger or the sub ledger that attaches to the ledger, the core ledger is in place. Did I re-summarize that the right way, or did I just mess that up completely?
No. Yeah, I think you painted an accurate picture there. And to your point, the scalability of that, FBO model or the ledger model is really what made it so successful. Because again, yes, it's cost incentive to have that one account, and then 1,000 accounts in your scenario under that one, and everything like that. So it does allow scalability. And really, I think where the missteps are is not only should the program manager be reconciling, but the fintech and the bank should be reconciling as well. So each has to contribute to that balance and ensure that what I say I have is what you have and what you have. And I think that's where a lot of the hedging of the risk is played out. Is not everybody was keeping in balance at all times with one another. And I think we're going to see, probably, in my opinion, again, regulators come out with something that says each party has to maintain a ledger that, again, can balance back to each and one another. And I just don't know that everybody had been doing that up to this point. Again, pure speculation on my part, but I can see that played into what we're seeing right now.
Yeah, I got you. Okay, so let's talk about another way to do it. I know you had mentioned sort of a one-to-one relationship, which might make it easier from a balancing, because the balancing then is the account balance, right? Sort of. So how does that look? How does a one-to-one look? And is it, give me the kind of the positives and negatives of doing it that way.
Yeah. So again, as I mentioned, we spent a lot of time researching how we wanted to enter this market, and again, took the better part of 2 years to get to where we are. And we did look at the program manager model versus just using our core. So I will go ahead and plug DCI as our core platform that we use, and they've been great to work with. And so what we've done within our DCI core is we provisioned a separate fintech branch specific for our fintech partner. And the way this is going to work is through the API calls that are coming from our fintech into DCI. We'll actually be opening an account for every customer the fintech is onboarding through their system, they'll actually have an actual Riverbank bank account sitting within our fintech branch. And so maybe the long way, the hard way, or the more complicated way to do it, but we feel like that's the best way for us to manage our risk, because we'll know exactly who the customer is, what they're doing at all times, and we can manage to that transaction activity that they're going to be pushing through, because then we get to run it through all of our risk monitoring, risk scoring, fraud analytic monitoring, and everything like that. We're going to treat them just as if they were a customer that came in off the street, because they're going to have that CIF record, they're going to have an account number, they're going to have the routing number associated with everything. And again, we have everything and anything that we would need to have on that customer, from a KYC, KYB, BSA, AML. Everything is going to be fully monitored and reside within our core as a one-to-one relationship as they pass through that fintech's onboarding and into our fintech branch within our core.
Okay. So, and that does make a lot of sense, is obviously the more exposure you have to them, the better on your end. And if you treat them as a branch, you can see what's opened at the branch, or, I'm sure there's a couple of different ways to sub that out within your, within your set of accounts. So
Sure.
how do they handle documentation, even just account opening documentation, when it's a multiple to one account relationship, right? Like how do they even, I never thought of that before, but if you only have one account on your end and you're required to make sure that the fintech has account opening documentation, right? KYC or whatever, right? Know your customer kind of thing, right? How do they accomplish that within the program model, within the multiple to one model?
Yeah, that's a good question. So again, my assumption is that the fintech and the bank at some point had to agree upon what legal docs they wanted to use or were going to use. And sometimes the program manager, that's the other benefit and value of a program manager. They really try to layer that in as well. And that's their sales pitch somewhat to a bank is, hey, we've got all the legal and risk documents already. We just need to, put your name on them as basically financial services being provided by whatever the bank name is. And then the fintech is also on those docs. So they're kind of co-labeled or co-branded, so to speak. And so I would again assume that's how they're doing it on the program manager side. So I don't know that there's a lot of deviation there, but I don't know how much the bank is involved in dictating what the disclosure should be and what they're going to be required to have or maintain within that framework. So that's
Right.
kind of an unknown to me.
I guess I could see the banks handing out the framework and just making the assumption that each customer filled one out.
Sure.
Right. But again, I mean, back to your cross-checking, at some point you should go audit and find out if you got the right documentation of those customers, because if you're not, and again, most of these things I think are online business. If you don't have it, you end up, I would imagine a few different problems you could end up with there. And I don't know how the bank would audit that necessarily. Might be a little bit tougher, but okay, it's helpful.
Yeah, and I can tell you how we're doing it is we have full access into our fintech's compliance platform. So for, again, every customer they're onboarding, every due diligence doc, every signature card, anything and everything that customer has associated with their banking profile or relationship sits within that compliance engine of our fintech partner. And then we have transparency into that engine. So again, that's we're doing it maybe the harder way or the longer way, but we feel like that's what's going to help us continue to maintain not only a good rapport within the industry, but ensuring that the fintech is holding up their end of the bargain, but also we're holding up our end, because at the end of the day, it's our risk to bear and our risk to manage. And so we want to ensure we're doing it the right way and holding not only the fintech accountable, but Riverbank as well.
Okay. So let's talk about assets real quick, right? It's always fascinating that the fintech's assets sort of become the bank's assets, right? And let's just use deposit accounts, or I guess you could do the same thing with loans. But so on a call report, the day after you sign up a fintech, and if there is assumably there's assets there, right? Otherwise you wouldn't be doing business with them.
Sure.
How do I struggle a little bit with why assets aren't kept separate between the fintech and the bank as the bank reports assets? Can you help me with the ratios or any of that stuff, right? That kind of go around with mine versus yours.
Sure.
Comes asset basis.
We'll be right back.
Is your technology spend getting a little out of hand? Are you worried about making those big strategic moves because of those hefty vendor contracts? Or maybe you just feel like your technology is currently holding you back. In today's banking world, overspending on technology is a risk you just can't take. Going up against those major vendors on your own can be tough, expensive, and especially when the contracts are designed to benefit them. That's where Remedy can come in. Remedy Consulting helps our clients stay competitive and grow their business with the right technology, products, and their spending strategies. Not a Remedy client yet? Head on over to remedyconsult.net for a free review of your tech stack, spending, and contract terms. Even if you're not the perfect fit, you'll walk away with expert advice and confidence in your technology decisions. Check us out at remedyconsult.net or give us a call at 262-955-7776. Thanks for tuning in, and now let's get back to the episode.
Yeah, and I would say that's one of the reasons that we chose to go the direction we did as far as having a separated branch specifically dedicated to this fintech, because then that does allow us to have, the measurements and the metrics from a call report perspective to know exactly what is transacting, what are the deposit dollars associated that are bringing into the bank from the fintech. So again, that gives us that ability to measure again what is standard Riverbank versus what is fintech Riverbank. And so that's how we're going to manage to that, to kind of address your question, is as they bring those deposits in, we're going to be able to see exactly what that looks like, who that customer base is, and where those deposits are evident and flowing, and how they're growing and everything like that. So again, that's the design that we're approaching it with, is to be able to have that full transparency in what is related to our fintech partnership versus what is just standard Riverbank customers and everything like that.
Okay. So then the last question I want to ask you is related to, what does a collapse of one of these things look like? And I'm talking about the fintech itself. And here's my theory is this. Banks have been around for a long time. The bank is probably more stable than fintech. Fintech's a startup. And you may have to go through a few fintechs as partners that may fail.
Sure.
More likely to fail than you are, let's say. Right. So the two things that come to my mind are sort of liquidity, right? Does that cause a liquidity problem? And then sort of who owns the account? They're theoretically in this one-to-one relationship that we're talking about, the account stays there. So the account exists. You could find the account. You wouldn't have the Synapse issue, right? You wouldn't have this middleware. We don't know where the account is. If the fintech collapses, does the bank then have these accounts that have been set up with the balances in them, with no service they can provide? They just don't have the fintech service they can provide that customer? Or what is that? Help me understand what that looks like.
Yeah, no, that's a great question. And it's one that actually the regulators are looking for us to address and answer. We just actually completed our safety and soundness exam with our state regulator. And that was, I think, one of the most prominent things that they had requested of us is develop that strategy. What does that strategy look like if you need to unwind this fintech partnership, whether that's just because you're ready to exit the relationship, or to your point, there's something that's happened that's caused them to no longer be in business. And so that's one of the things that could get creative, right? Because to your point, the way we're doing this, we will have those accounts. Those customers are Riverbank customers, not just the fintech customer. And so what we would have to decide is, do we want to try and spin up services on our end to allow them to continue to bank with us? So that's a strategic decision the bank has to make, is, do we want to continue to bank these customers, or do we want to exit those relationships? And so that's one of those decisions that has to be made at a strategic level. And I would say it's one that you have to understand, what is the technology you have available and how quickly can you spin that technology up to deliver the solutions that allow them to, again, operate on a day-to-day basis. And I think that's what's important, as in my opinion, again, when you're looking for a fintech partner, how closely do they align with your banking model? And in this, event, if that were to occur, is it and I won't call it a seamless transition because nothing's ever seamless in technology, but is it a transition that could occur because you were so closely aligned with what the fintech was doing and how they were operating, that you could migrate that customer into, let's call it, your online banking program, your ACH, your wire services, your mobile deposit services. And so the disruption is as minimal as you could possibly make it, but you have the ability to onboard that customer base through that platform. And a lot of that's going to be dependent, obviously, on the technology you have available. So from us, from a core perspective, can our core deliver all those solutions? And if you're in the program manager model, again, most of those program managers have the ability or the scalability to do that as well. But it's all about timing. How quickly could you organize to get that, available to that customer base?
Okay. Because I would think that the reason that customer went to the fintech is they found some niche that they liked within them, and probably technology niche is my guess, right?
Right.
I had a conversation with another person on the fintech side the other day, and we were talking about liquidity. So let's use another scenario where the fintech pulls their model and gives it to another bank somewhere in the middle of the relationship.
Mm-hmm.
Now you have a liquidity issue because, at one point you had deposits sitting there and now you don't. How do you protect? I'm assuming there must be protections against how long you're the partner. Can you have multiple, exclusivity? Am I the only partner, or could you have multiple partners, multiple bank sponsors? Through any of that, or is that just something you're still working on?
No, yeah. So that's a great question. So that's one of the things that you definitely want to make sure when you're designing and creating that contract, it's very clear, what that situation would play out. But it's also one of the things that we built as we were developing our strategy is what percentage of deposits do we want to maintain under the fintech umbrella? So as a percent of total assets to the bank and total deposits to the bank, what percentage are going to be dedicated towards fintech? And that's something that I'll tell you again, the examiners are going to look at. They're going to look to see what is that percentage? What is that number? And so it's something that every bank should be considering to be able to have that as your barometer or your gauge to know.
In case that fintech takes off, you mean? In case all of a sudden they're doing all kinds of business and you want to make sure you get control. Okay.
Yeah. So again, I go back to what I kind of illustration I said earlier. It's load balancing, right? You're no matter what, you're managing risk. That's the role of a bank, is managing risk, and that risk comes in many forms. And one of those is going to be deposits, and how are you protecting, your assets and your core deposits versus what's coming into the fintech. And when is a point that you have to decide, okay, we either need to, ramp up or scale back based on what's happening. So again, we put some provisions in our contract to be able to manage to that.
Great. Riverbank, just give us the asset size and where you're located up in the Washington area, correct?
Correct. Yeah. So we're in Spokane, Washington State. We're 250 million in assets. Riverbank started as a de novo bank in 2006. We're very unique in a sense. We only have one location and we primarily focus on business banking. You would say our niche is making business banking easy. To be uniquely better, that's kind of our motto, and our vision is how do we engage customers in a way that's meaningful to them, but being able to deliver all the right solutions at the right time in the right moment so they can bank when they want, how they want, where they want. And that's kind of been our focus of delivering that unique style of banking. And we've done that from the beginning.
When did you go down this fintech path? Like when did you start? I know you said the first one's still starting to spin up, but when did you start researching it, or when did this sort of become one of the strategies of the bank?
Yeah, great question. So around May of 22 is when we started exploring what fintech could look like and really trying to understand the industry as a whole. It was becoming really popular. And so one of the things that we did, and when I say we, myself and our CEO, Mike Wilson, we literally just tried to get in front of anybody and everybody we could that was in the industry that seemed to know what they were doing and why they were doing it and everything like that. So we had a ton of meetings. We traveled, get a lot of FaceTime with anybody and everybody we could. I will go ahead and plug another group. So FedFizz and Bankers Helping Bankers, that group really was a huge help. So the FinTech Cowboys, if you never heard of Dave and Tanner Mayo, they were a great resource to us and continue to be a great resource to us. And then again, DCI has been a pivotal partner in helping guide us and coach us along the way. And so we're very appreciative of all the people that have helped support us to get to the point that we are. And it's a lot of work, right? Again, it took us 2 years from the start of, research to developing a strategy to presenting to the board to presenting to, the rest of the bank. We've kept all of our bank informed every step of the way of what we're doing, why we're doing it, and how that impacts, not just me, but them and how they can support us and Riverbank as we go on this journey together. And we've been very transparent. We've told fintechs no. And one of the best pieces of advice I could tell anybody in this, if you're looking to get into it, is know who you are, know who you want to be, and don't be afraid to say no when it doesn't make sense or you don't want to create that partnership. And we've told fintechs no, because it just didn't align with what we wanted to be. And that's what took us a little bit longer. It did take us some time.
Yeah, sure. And so did you change your core to get to this one-to-one relationship, or have you always had DCI as your core? Like how were you thinking about the core relate? Did you have to do anything as you kind of pulled the strategy together?
Yeah, so DCI has always been our core. Again, one of the things we did in our original research is we did look at the program manager model. We visited with multiple program managers to understand how they would build this and what that would look like for us. And then we obviously had a lot of interaction and engagement with DCI to understand, okay, if we did this through the core, how would that work? What would that look like? And we, again, felt as an organization, it just makes more sense for us to partner with DCI based on what they're doing within the industry. I think they're doing something very unique in the industry and how they're offering this to their bank partners. And so we felt like that was the best route for Riverbank to utilize them and
that's
leverage
kind
their
of
technology.
Chose your one-to-one versus your sub-account relationships and that type of thing. Okay, excellent. That's all I had for today. Is there anything else we missed? If not, otherwise we'll just wrap her up for the day.
Yeah, no, I think we covered a lot of ground. I appreciate, again, you allow me to do this with you and share the time.
Oh, this has been great. Yeah, I think you hit it on the head. I mean, as far as the number of things that we covered here that are related to anybody who's getting into the industry, I find it fascinating that you go from one bank CEO to another. One doesn't even know what the term means, right? And the other one is so engaged in it that this is going to be the beginning of their strategy or the strategy go forward or what have you. So it's good to have the experience. And again, I understand you guys are still in the middle of taking on your first fintech, but
sure,
that build up and the experience you've gained over the last couple of years, right? The research, it's just critical, I think, in this and build the right program.
Yeah, absolutely. And I hope the industry continues to thrive in this manner. I always throw that out there. I'm a resource. If anybody ever wants to, contact me, reach out to me, because I want to do it right. We want to do it right. And we want the industry to thrive because there is a lot of opportunity. I think the more banks that do it, again, what I would call the right way, the better off we are, especially in community banking. It's what we thrive on. It's the future of what community banks can do and deliver, because we say we were different as a community bank because we're founded on that relationship model. And I think it should be no different with our partnerships. Everything should be based on that relationship. And if we can scale that and, take that to the industry, it could really transform the future of bank.
Excellent. Well, thank you very much for joining us today on BankTalk. It's been
absolutely.
Thanks, Chris.
Yeah. Have a great day. Thanks.
All right. So that's it for BankTalk. Once again, I want to thank Chris for joining us, and for all the rest of you listeners out there, hopefully you gained something by this. Have a good day and keep on learning.
Thank you for listening to the BankTalk podcast, brought to you by Remedy Consulting. To reach out to Chris or learn more about Riverbank, go to riverbankonline.com. Once again, riverbankonline.com. Thanks again, and we will see you in the next episode.